Well, it's the start of September, guys, and September is usually a pretty terrible month for just about everything in markets, for whatever rhyme or reason. In fact, September clocks in as the worst month of the year for the S&P 500 over the past 10, the past 20, the past 30, all the years since World War II. NASDAQ is in a very similar situation. It turns out it's a very good month for bonds. Over the last 10 and 20 years, it's either been the best or second best month of the year for ZN or ZB. This is not a typical type of risk-off market, though, in September when these things usually occur, because gold prices get whacked. It's really a sea of red. It's a capital raise type of environment. So that begs the question, what just happens in September? And perhaps as I walk through some of these terrible things of September over the past, say, 30 or 40 years, given how you guys were trading around a lot of these events, I'm curious to hear your own insights about how they impacted your outlook on the markets during those periods of time. The first one perhaps isn't that big of a deal, but it is something that we've come to learn more about in recent weeks because of what's going on with the Bank of Japan. And that's what happened in September 1992, September 16th, 1992, in fact. The Bank of England was no longer able to maintain its exchange rate versus the German Deutschmark, and it has to crash out of the euro. The Bank of England is broken. It helps create luminaries like Stanley Druckenmiller, George Soros along the way. I guess the question here is, as we go through these four different events, as I explain the events to you, perhaps you can explain to us, was that 1992 market meltdown something that you guys saw as a stumbling block for our markets here in the United States?
I don't remember the 1992 meltdown. I remember the mini crash in 1989, and I remember the sell-off, but I don't remember it as a meltdown, because after what we went through in 87 and 89,
92 was nothing. I mean,
92 was nothing.
Right.
I think 87 was October, 89 was October. We always were relatively flat going into September and October just because of, everybody got scared from the prior two events.
September's typically a bad month for the market.
I mean, that's what they say, but September is also triple witching, and there's no such thing as a bad triple witching cycle. I mean, maybe in the last 2 years, but generally speaking, all tripping witching cycles were up. So the problem with September is that you're always, it might have been a little bearish after Labor Day, but you always had to deal with triple witching, which was always bullish.
September seems to be a problem for not just international markets, right? Although in the 90s that was definitely the case. Long-term capital management goes down. We have the Asian financial crisis that really kicks off in the summer of 97, but it spreads through markets in September of 97, and we go into the LTCM issue of 98, and of course the dot-com burst of 99. And we've been talking about this a lot here in recent weeks and months, guys, is the equity market rally that we're seeing reminiscent of the bubble in U.S. equities that occurred in the late 90s. Because while the dot-com bubble gets its affinity for association with Y2K, you could make an argument that it really began back in 1995, given how the stock markets started moving all those years ago. So as we work through these terrible Septembers here, we go back to September 1997 through September 1999. What was it like trading through a bubble? And, Tony, to you first, I mean, do you guys find any analogies or any read-throughs to today's price action, how this market structure has evolved or changed?
For me, you never know you're in a bubble till you're past the bubble. It's almost like a recession kind of thing. Volatility, if I remember correctly, wasn't really measured back in the 90s the way we can measure it today. So it's a little hard to say, but it seemed like there was a lot more two-sided action to a bubble than what we have right now. You always felt like, at least from my experience and memory, you were like selling the bottom because we would rally the next day, and we would rally another day, and then we would come down and test new bottoms and then rally again. And that was kind of more of a capitulation of the bubble kind of thing. I don't know if we're anywhere near that right now. We've had these V bottoms, which are a new phenomenon over the last 10 or 15 years, for me at least. We used to have a lot more rounding out, like you didn't have to rush into anything. We're here, it seems like once we turn around for good. So they're a little different for me. I'm hoping that the top comes like the bottom. Maybe we get a V top before we test another V bottom.
Tom, from the late 90s forward, we see another September market crash in September 2001. I don't think we really need to explore why that happened, but it does pose another interesting wrinkle where in September 2001, the market starts to go down and it doesn't recover for a little while here. It's obviously catalyzed by a terrorist attack and not, the trade balance or the Federal Reserve
Yeah.
How did you guys find yourself climbing out of a hole when you have a market meltdown triggered by something like September 11th?
Well, first of all, the bear market started about a year earlier. It started in April, March, April, May the year before. But so we were deep into that kind of, we were 1.5 years, 1 year into that sell-off already, and the market had gotten pretty ugly. And I felt September 9/11, I felt that was probably the binary event. Like all we wanted to do at that event was buy everything. I still remember to this day on September 11th when they shut the markets down, thinking about all the different. Remember 2001, the ETFs didn't trade. I mean, obviously the futures did, but there wasn't really the VIX barely traded. Then it had just come out or something like that, and it wasn't the same amount of instruments as there are today. And so all we were trying to do was buy a bunch of different stocks right after that 9/11. I don't think I wanted to jump on the indexes as much as I wanted certain individual stocks, which I thought got crazy cheap. I remember
until they went cheaper.
No, but I remember putting an order to buy like a bunch of Southwest Airlines at $6.20. I don't think I got filled on it all, but like AMD, there was all these stocks that were like in the $4, $5, and $6 range, and we were trying to scoop up everything. I mean, American Airlines, got down to $1. United Airlines was dirt cheap. I don't remember how low it got, but I do remember buying a bunch of American Airlines, buying a bunch of Southwest Airlines. So I looked at the 9/11 as absolutely as a binary event and considered it, something that was, it was important. Let's put it that way. I didn't look at it as I don't count September. I don't count September as anything other than, a terrorist attack.
We work our way through the calendar here. It brings us to September 2008, of course, the Lehman Brothers crash. I have my own personal funny anecdote. My aunt was a managing director at Lehman Brothers back then, and she was part of this meeting where she, among others, like Dick Fold, go down to the Treasury on Maiden Lane in New York City to go speak to various officials and see if they can get access to the discount window. And they're told that they're not allowed to, so she takes her cab to go up to her apartment right off at 23rd and Park. And by the time she gets home and turns on the TV, you have Ben Bernanke and Tim Geithner standing there talking about how they're giving access to the discount window to banks like Lehman Brothers. Banks like Goldman Sachs. And that obviously triggers this big widespread market meltdown. The Fed's segregating which banks are going to be the winners or the losers out here. That was obviously the midst of a big crisis, probably a perhaps once in a lifetime kind of crisis. We hadn't seen anything like that since 1929. COVID springs back some of those memories in terms of there being an emergency in markets, but not quite. So with September 2008 being really the last or one of the last times that we've had a bad September, I guess there are two questions I have. One, have we noticed the fact that September may be weighed down when we talk about it being a bad month by these very significant outlier, historically unique events? And second, what did you guys learn trading out of the global financial crisis, which I know we've talked about and you guys have done plenty of documentaries on, but September 2008, bring us back to that mindset. What was it like trading in the pits on the floor those days when, quite frankly, it looked like the world was ending?
We weren't. So we weren't. We were running. I mean,
on the electronic floors in my head, I'm saying.
Yeah. At that point, we were out of the pits and we were running, think or swim. I can tell you my take on it because think or swim was really financially, we were as stable as, we had no risk whatsoever, but I was worried about other firms. I wasn't worried about counterparty risk, because I wasn't worried about OCC and I wasn't worried about clearing. I was concerned that Bear Stearns was crashing and burning, because it wasn't just Bear Stearns.
Could take a downturn.
I mean, it was Bear Stearns, Goldman Sachs, obviously Lehman, but at the time in September, I don't think we know how bad Lehman was. It was Merrill Lynch, it was Bank of America. I was worried about all these other big financial firms. I just couldn't believe how pathetic and how bad, they were doing and how they just were so unprepared for what was happening in 2008. At Thinkorswim at the time, like I said, we had a lot of active traders. The only risk we had on our books at all was just a couple of VIX positions, which, we knew they were risky, but that's it. We just took the loss and it meant nothing. It scared me when E-Trade basically went out of business because I thought, if Citadel didn't save E-Trade, E-Trade was going out of business. And I did get a little concerned about the industry in general. I couldn't believe Merrill did it again. It's down to whatever, like $3 or whatever they got down to, that Bank of America did it again. I couldn't believe that Bear Stearns, I always knew how cocky Bear Stearns was, but I couldn't believe that they actually blew up the whole firm. I just couldn't believe it. I mean, nobody could. We were sitting there watching these guys for, 25 years, 30 years. And all of a sudden we're like, how do they do that? How could they be so bad? I mean, at that point, Lehman was less of a surprise and we didn't interact with Lehman at all. So Lehman didn't mean as much to us, but Bear Stearns, that was weird. And all those other firms, that was weird. And E-Trade, that was weird. The firms that handled active option traders, like at the time, like maybe Options Express or, Interactive Brokers, I wasn't worried about those firms at all. But the firms that, like the firms that had laddered out all these and had gotten into the mortgage loan business and had laddered out all these, various
swaps.
Yeah, interest rate swaps and gotten into all that space because it was so lucrative. They were taking like 100 basis points. So instead of the normal 50 or 60 basis points they were making, they were taking 100, 200, 300 basis points off those trades, and they completely disregarded the risk. They looked at us, they were like, because we had these discussions internally, why don't we do some of these credit default swaps with our free cash? Like, why wouldn't we? Because instead of making nothing, basically, we can make 200 or 300 basis points on a few $100 million at least. And what bothered us the most is we couldn't figure out why. Like, I know this sounds crazy, Chris, but we would sit around. I remember Scott and I having this discussion and going, okay, if everybody's doing this, why are these spreads?
All the cool kids are doing it.
If everybody's doing this, why are these spreads still so high and going higher? Like, why is this? Something's got to be wrong. Like, it didn't make any sense to us how you could make 200 or 300 basis points, quote, risk-free if you weren't taking massive principal risk. Like, it just didn't make any sense. And so we're like, no, we're going to pass. And everybody was hitting us up for this. And we're like, no, something's wrong. Like, it's not our business. And we're not going to give you guys any money. They're like, well, the principal's guaranteed. The principal's, there's no risk at all. None of these, and it was all risk. And so, I mean, I don't know. I mean, I feel like if we were smart enough to figure it out, I don't understand why anybody else couldn't figure it out. It's almost like the FTX thing. It's like FTX thing. The firms that didn't do business with FTX, they didn't do it for a reason. Like it's like they knew something was wrong.
It just didn't compute.
It's what Terry Duffy said when they interviewed him. When he talks about the FTX thing, he's like, I talked to Sam Bankman-Fried. It didn't make any sense. Like, none of it made any sense. So we didn't do a deal with them. The group that, Zero Hash that we've invested in the crypto space, Edward's like, he didn't make any sense. We couldn't figure out how to get to the, like, if it doesn't make sense, you can't do it. Anyway, that was 2008, September. September wasn't the really freaky month. It was like October, November, but whatever. It was scary. Not for us.
September and October.
Yeah, not for us, though. The crazy thing, not for us, but it was scary for the whole industry. Like, we never faced any issues, but I was nervous about the industry.
I think one thing that we can learn from all these events is that ultimately, unless they are systemic in nature, they tend to disappear within a few months. Heck, even September 2008, when that occurs, the bottom is found 6 months later. I think traders may have also just learned what happened in August this year. If you see panic in the market, if you take the right time horizon, you can capitalize on that fear. So while September 92 and 97 and 2001 and 2008 were all terrible, if you faded that volatility and you looked, say, 3 months or 6 months out, you were looking at a market that ultimately would probably swing in your favor. And to remind everyone, in 2022, when the market was going down, vol sellers had a lot better of a time than people who were directionally long. As we talk about 2008, I thought I'd bring a happy note here to the end of a news story that I saw over the weekend. A $308 million note backed by the mortgage at 1740 Broadway. Only 74% of those bondholders in that tranche were paid out. The AA, the single A, the rest of the tranches were all wiped out for this commercial office building in New York. So we've been talking about the regional banking crisis since last March, when SVB and Signature Bank went down. And given the largesse of the Fed's balance sheet and the support they provided to the banking system, odds were that nothing else would really break. But the skeletons are starting to fall out of the closet. And I'm not saying it's going to be September 2008 again, and certainly a Fed rate cut cycle beckons. There's a reason why September and October are so spooky. And so as we look to these next 2 months of trading, let's be mindful of what's happened historically. Let's not get drunk on this VIX near 15 or 16 again, because that was very Well, that was silly to do so in July. This time there's actually a better reason not to.